Treasury yields ended this week at their lowest weekly settle since September 6th, and a lot is really going on in the market. Recall that back in early September, we traded yields down as low as 142. Then we saw them move much higher, close to 190. Now we're back down to 165, 166 with a low today or this week of 162. And it seems to me that the market right now is still trying to find its sea legs. I think 142 seems very low. Anything above 180 seems very high. And at this point, the market is still trying to find out where it's going to be dragged. And I say dragged because a lot of the uncertainties that are out there remain, pretty much an enigma, whether it's trade, whether it's Brexit, whether it's geopolitical risks overseas, or whether it's risks in Washington here. There's a lot of uncertainty, and then you take in separately the Fed and the short end disruptions we've seen over there over the last week and a half. It adds up to a market that really is being dragged back and forth. We aren't seeing much of a trend trade. We saw Treasury buying going back to March pretty steadily all the way up through August. And then all of a sudden, towards the end of August and September, things changed and the market started to sell off and we started to see yields rise higher. And now we're starting to see a very choppy back and forth trade. At this point, I think that the market will lean towards caution, which means lower yields and higher prices, at least until some of the fog clears. And that is, some of that fog, we get bits and pieces of it here and there, but it never really sticks. In the Treasury market right now, the volatility that we're seeing, it remains elevated, but it's not through the roof. You would think that we'd be spiking at real high volatility considering we're seeing this back and forth trade, and we're not. And if you go back to like 2018, we saw yields volatility barely get above 4.5% in the 10-year, and now that seems to be the new low is 4.5%. So again, things change very quickly, very slowly, but right now we seem to be holding volatilities at elevated levels, albeit off those year-to-date highs. Unless it's like, what do we have coming up ahead? Because obviously we're going to still talk about trade, whether it's the Chinese are coming over to the U.S. to visit to talk, or whether President Trump is going to make some sort of announcements, or they're going to work together or against. It's sort of a day-by-day thing. And there's also, aside from the trade talks, we're going to have continued political whatever. And that tends to have a real negative effect on the market. If you see it in stocks and you see maybe a little bit of a positive swing in Treasuries, certainly is creating a lot more questions than answers. And lastly, we're going to get the jobs number. It's going to be, the economics have really been overlooked a little bit. A strong jobs number would do a lot for what the Fed has said they want to do, which is be patient when it comes to cutting rates. A weak jobs report will certainly start to get the talk of a 50 basis point cut coming before the end of the year back on the table. At this point, we do have 125 basis point rate cut baked in, but there is starting to see rising odds of a 50. If we start talking about 50 basis point cuts before the end of the year, that's really going to throw a wrench into what the Fed telegraphed earlier at its last FOMC, its last few FOMCs, which is they want to go meeting to meeting, kind of see how things go. But at this case right now, Treasury yields creeping lower, volatility going higher, uncertainties not being resolved. I think at this point, buyers of dips will continue to be very aggressive. Likewise, as we hit quarter end and month end, that's going to create some stresses in the short end when it comes to scarcity of dollars that we've seen over the last week and a half. It's going to probably be very exaggerated. So look for Treasury yields to continue to creep lower. Obviously, the jobs number could change all that next Friday. That will be the key moving forward for the month. But right here and now, it seems that the Fed is geared to cut for 25 basis points by year end, possibly 50 if things don't go their way. But again, we're going to get a lot of Fed speakers next week, especially Mr. Clarida. He'll be talking several times, and that will be something to watch. He always has something very key to say about what's happening in the moment. And lastly, I like to think that after the big moves that the market's made, it will start to make some conviction moves, ones we haven't seen. Obviously, we've seen the down, we've seen the up, and we've gone back and forth. But at this point, I need the market to kind of hit a sustained period of maybe one directional or sideways trade instead of the bouncing around we've seen. But that will only come when we get resolution and all those uncertainties and all those uncapped bottles that we continue to talk about here, focusing solely really on trade with China and U.S. growth and U.S. politics. We can get those things resolved. I think the Treasury market will find its footing.